Hey, it's Dan Leech, and I was talking with Ryan Shultz of New American Funding last night, and he was telling me about some of the loan programs that they currently have that are actually very interesting and would probably work really, really well for a number of our clients. And I thought, as he was talking, I thought, man, it would be fantastic if I could just have you just drop by the house here and we can go ahead and talk a little bit, and you can give me and everyone else some more information about what those are, because if I try to explain it, I'm probably not going to do a really, really good job. But with you doing it, you'll do a much better job.
Yeah.
So, hey, tell us about one of the programs was that program that actually was out here before. It's the Dreamers program. What's going on with that? I know there's a lot of bugaboo about that.
Yeah, let me tell you about that.
Okay.
Very exciting program. It's called the California Dream for All. It's from CalHFA, which is a California state program that helps down payment assistance for clients.
Okay.
So we use that quite a lot. This program came out probably 6 months ago or so. They had $300 million ready to use for down payment assistance.
Didn't that go like?
It was gone in literally, I think, six days.
Yeah.
And how that worked, we'll go back a little bit. The reason that was so exciting is because this is a down payment assistance that gives 20% down. So most down payment assistance are a small amount, 3%, 5%. This was giving 20%. So a client could come in, get 20% down. That means that their first mortgage is obviously much lower. They have no mortgage insurance, so it's a much better payment, and it's a great way to get into a house.
Right.
The catch to it it's called a shared appreciation loan. So they're giving 20% to use. It is basically a silent lien on the property. It sits on the property. They don't have to make payments back on it until one of a couple things happens. If they sell their home, they got to pay back the amount that was loaned to them, plus shared appreciation. So what that is, they would take whatever the amount that was loaned to them, say it was $100,000, and if the home went up, say $200,000 in value when they sold, they would take 20% of that $200,000, so $40,000, and say, okay, you need to pay us back the $100,000 that we gave you plus $40,000 that we basically made.
So the state would make money on.
The state was making money. They're kind of like an investor in your house. Right. So when you sell it, they're taking some back.
Still a good deal, though.
Great deal.
If you can get it.
Exactly. So it was a great deal. A lot of people got excited. A lot of people used it, and it was gone instantly.
Yeah.
Originally, they had $500 million, I think, planned for it, and they only released $3 million. So what they've done now is they're coming back out again, and I think they have $255 million this time for it. But they've changed the guidelines completely.
It's not easy, is it?
It's a lot different.
Almost like better getting the lottery ticket and trying to win.
It's similar to a lottery ticket, yeah. So how this works, now it's still exciting, and it's still something people should be aware of, but qualifying for it's a little bit different. They're trying to make this a program that really is helping the underserved or the people that are more in need. Because before, everybody registered, people that maybe had 20% to put down, still decided to use the state's money instead of their own.
Okay.
And a lot of it was done here in Southern California, so the money was gone like that. Now the way they're setting this up is that you have to qualify, and the eligibility requirements are a little bit different. They've made the income limit a little bit lower. You got to make under $155,000 to qualify. You have to not only be a first-time home buyer, this is a biggie, you have to be a first-generation home buyer, which means...
It'll be kind of tough to qualify for that.
Pretty tough.
Yeah.
That means that you cannot have owned a house in the last 3 years, and your parents could not have owned a house in the last 7 years.
Okay.
Okay? Now, if there's two people on the loan, husband and wife, at least one of them has to fit that category. So that's going to make it a little bit tougher. Also, they're making it geographic.
Okay.
Yeah. So basically what that means is they do not want a high concentration of it right here in Southern California.
So they'll spread the wealth across the state.
They're going to go right. We want a Fresno, Sacramento. We want stuff like that.
Yeah.
And it's drawn on a lotto. So before it was first come, first serve. Everybody rushed in, put their applications in, got it in, like I said, in 6 days. Now they do not want it to work that way. So the way it works now is basically we would pre-approve you for a loan. We get you registered with CalHFA. You kind of go in on the pre-registration time. And then they have a date when they're going to choose people. And they will choose you through a lotto system, depending on where you're at.
Okay.
And if you get chosen, you get a voucher that says you have X amount of money you can use, and you have 90 days to get into escrow.
Okay. Now, is there... This one's going to be really, really tough for people to actually be able to get. Does New American have something not exactly like that, but similar to that people can take advantage of?
We do.
Okay.
Yeah.
What is that about?
And this program, like I said, it's great. It may work for some. And what we're going to do as a lender is we're going to pre-approve a client, and we're going to basically be looking at all the different options, right? So if it looks like this may be something for you, perfect. We will get you registered. You know that you're in that system. You may get called for that. But at the same time, there's a lot of other programs. Mm-hmm. There's the CalHFA down payment assistance program where they give you the standard 3.5% to 5% down. You don't have to fit as many regulations as that one. New American Funding, we actually have one of our own called Pathway 100, and you do not have to be a first-time home buyer. You do not have to fit an income limit. In fact, it works in every state that we do loans in, which is everything but New York. Mm-hmm. And this one we give 3 to 5% down, and it could be a forgivable second where you don't have to pay it back. The credit scores are a lot lower; it goes down to 620. So the guidelines are a lot looser and easier. And it's just another way to get into a property. If you don't have any money right now, it's a great way to take advantage of some of the programs.
So you may still have PMI, private mortgage insurance, on that, unless you go over the 10% threshold with the combination.
You can do, yeah, you can do that. You can even do the minimum down 3% down, and we give you 3% as the silent second, mm-hmm. or the second, and then we can do a no MI program on top of that. So you can do 3% down with no PMI.
Okay, cool.
Yeah.
And then you were mentioning also another program which is similar to one that we had before, that was if you were a seller, a homeowner, and you wanted to sell your home, but you were concerned about, hey, there's so many buyers out there that I'm going to get outbid on every single thing, right, unless I have cash. But I don't have enough cash because I haven't sold my house yet. So explain how that program worked, and then explain how it's been adjusted a little bit now to this newer program.
Yes. So that's another great program. It's called NAF Cash, New American Funding Cash, and it's geared towards either a contingent buyer, someone that needs to sell their property first, or
those crazy clients, just
another dream full of client.
Yeah. There you go.
Good thing it's not a first come first serve. We can still register.
No. There you go.
Still get registered. The NAF Cash program is allowing somebody to purchase a property without selling their property first, just like you said, right? If they are a contingent buyer because they need to sell to get the money from the sale to buy the new house, but they don't want to sell first and then not know if they're ever going to buy, where are they going to go,
right?
Or they want to place an offer as a contingent buyer, which, as you know, as a realtor, is extremely hard. Mm-hmm. So what we do is we pre-approve them for the new purchase, and we basically let them use a program called NAF Cash, where we say, okay, we know once you sell your property and you have $200 to put down, we know we can give you this loan for $700 or whatever it is. Mm-hmm. So we pre-approve them, give you a bank statement showing proof of funds and instructions on how to write the offer for your client. So your client finds the property, says, hey, I do want to move here. I want to offer $800,000. You go, great, we're ready to go. You can write the offers all cash on that property. The program the contract's written in the name of New American Funding. We get that property off the market. We then write a second contract where we're the seller and the buyer is the buyer. So they know the property's ours, right? We're already in escrow on it. And so we let them move in. We close with that program, usually in cash in 14 days, let them move into the property. We have that escrow open. We have their loan approved. Now we're just waiting for you to sell their home. Once you sell, we get the money, we complete the loan and put that in their name.
Okay. So there's some transaction fees that are associated with
that,
right?
Yeah, okay. A little bit of fees. So we have a thing called a convenience fee, which is 1.6% of the sales price. Okay. So if we buy that property, we are going to pay closing costs as the buyer. Mm-hmm. We're then going to turn around and sell it to them or the client, so we pay closing costs as a seller. So in order not to lose money on this, right? We're not making money. We're just trying to facilitate somebody getting a house and helping them with the loan. So they have a convenience fee of 1.6%. Okay. So basically, if they bought the property or we bought the property for $800, we would turn and sell it back to them for, what is that, $810, mm-hmm. something like that. Mm-hmm. So we have one fee that's added to the price of the home, and that gets tacked on. Now, obviously people don't like to pay that extra money, but you could think of it in a couple ways. Number one, you're a cash buyer now, mm-hmm. so possibly you could come in lower than the list price and maybe get the home less. You tack the 1.6% on, and you still made out ahead.
Or, really in this market that we're still in, just having that extra tool to be able to come in as a cash buyer as opposed to a non-cash buyer, that can make a lot of difference in the eyes of a seller. Even though ultimately the seller is getting cash, whether it's a loan or not.
Right.
But there's other hoops and hurdles that a buyer who's getting a loan, they have to jump over and make sure that they are able to qualify, that the appraisal comes through and everything else. So there are some more things that a seller may not want to go with a buyer who is getting a loan versus an all cash.
Yeah.
So now the new program that you just told me about is similar, but it's for if a buyer does not have a home to sell. And
you can use this program either way. So we can use this program as a contingent buyer, or you could just be a regular conventional buyer. You're buying your first house. We approved you for 5% down, and you're going to go out placing offers on homes. You can do that if you're getting outbid, and you can't win because you're in multiple counter situations. You have other people that are stronger, putting more down than you. Then we can use the cash program. So you could pull the cash card and go, you love this house, right? We feel like there's going to be a lot of activity on this one. Let's go into your strongest offer. Why don't you go all cash, close in 10 days, no contingencies.
Okay.
Now your offer, instead of being a 5% conventional, right, which could be middle of the road, you became the all cash guy at the top. And that's how a lot of people can win the property. Okay. And then if you know you're going to get that little $10,000 bump to the price, I mean, a lot of times you may get countered higher than that anyhow. Mm-hmm. You might go in 5% down, you know you got to go at the list price, you got to go 5 over, and you get a counter 10 over, 15 over. Next thing you know, you're bidding, you could outbid your, that price. So we find it's pretty good. It's like it is a fee, but it's not so bad.
We didn't talk about this, but how do you handle the appraised value? So here again, if we're going to be in multiple counter situations and you're going 50,000 over list price, but we know that it'll probably only appraise maybe either 10 or 15 above list price. How do you handle that in this program?
Yeah, so how we handle that, because you're technically an all-cash buyer, right? So you would have no contingencies, no appraisal, all that good stuff that the seller wants to see, right? Quick, easy. How we protect the buyer in that case is we say you write the offer as, let's say, a 14-day transaction with a 7-day due diligence period. So that is kind of the buyer's escape window. So there's 7 days where once that cash offer is accepted, the buyer goes out, does their home inspection, make sure they like the property. We order a thing called a desktop appraisal. So we have a local appraiser pull the property up, do all the comparables like a normal appraisal. So they get 6 comparables. It's a 30-page report making all the comparables, and they come back and tell us within 3 days the property's going to appraise at 805.
Okay.
So we can go back to the client and go, hey, look, we're buying it for you. Here's the appraisal. Are you comfortable with the appraised value? If for some reason it's low and they don't want to go forward, then we cancel, deposit comes back, everybody's fine. But if they like it, then we move forward. Once we close on the cash program, we are going to get an appraisal on the property for them. It's the same appraiser, it's the same value. We know it's not going to change, so there's no risk in like all of a sudden a low appraisal.
Right.
So
good. I think the last thing is the Federal Reserve has had some rumblings that they may be reducing the interest rates in 2024. Don't know if that's going to happen, but that's kind of what we're hearing. From our perspective as agents and brokers, we're looking at that as right now we have a lot of buyers that are out there that are not jumping in because the rates are still high. I mean, historically they're very low, but for them they seem high. And I know that once we start seeing a half a tick or a full tick down in the interest rates, they're now going to jump in.
Right.
And that's going to cause kind of that frenzy that we've seen during COVID and even over the last 2 or 3 years. I think that may be, it'll be good for the market to a certain extent, but what are you guys hearing from your perspective as lenders about what interest rates may or may not do over the next 6 months to a year?
Yeah. So exactly what you said. When the interest rates were low, as you know, it was a buyer's frenzy. It's a situation where the seller has the advantage and everybody's overbidding and you're competing against people and you're going up higher in price.
A lot of people.
Lots.
Yeah.
Right. Lots. So now that the interest rates went up, it calmed down. We've had this nice drop in interest rates since the end of the year. I think it was close to 8. Now it's like 6.5 range. Yeah. So all of a sudden we have already seen more activity. I think the last offer that a client put out a couple of days ago, there's 12 offers on the property.
Yeah. So
now we're back to, oh shoot, I'm not the only one. There's 12. So what we're suggesting and what we think, interest rates are right now, like I said, 6.5 to 7, depending on your situation. VA, FHA could be 5.9 area. But they expect interest rates to drop by third quarter, or actually second quarter, around 6%, they're thinking, which will help. More people will get excited again. But our suggestion, do you want to wait for that rate to go looking for the house?
Because what will happen with the prices? Because the price
is going to continue to go up,
Yep.
and you're going to have to keep bidding higher to win that property. So even though the rate dropped a little bit, now you're paying $50,000 more for the price. So here's the recommendation. This is another New American Funding program that I think is great. We have a thing called a 5-year rate protection pledge. So anybody that locks in an interest rate or a loan with us right now, we give them a certificate. It says anytime in the next 5 years that you want to refinance, we are going to refinance your loan with no lender fee, no appraisal. So it's almost like a free refinance in your back pocket. You know, hey, I'm going to buy the house now. As soon as rates drop, I'm going to refinance. It's not going to cost me anything. And same thing, right? You've made that equity now.
Yep.
The sooner you get in, the better always, right? So you get in now, lower your interest rate, lower your payment later, but you've already made some equity.
How much equity would they need in the property to be able to do that refi?
I mean, just enough to qualify for whatever type of loan we're doing, right?
Okay.
So if they put down 5% and the property has not changed in 6 months, a year, we can still do the refinance. It would be a 95% loan.
Cool.
Yeah.
Great.
Yeah.
Thank you, Ryan. Appreciate it, man. A lot of great
problem.
information. It's always good talking to you. And if you guys have any more information or any more questions about the information that we talked about today, you can contact me or Colette or Ryan Shultz. We'll have some information about how to contact him as well. That's pretty much it. Until next time, talk to you real soon. Bye.
Thanks.